So the market has been in a bit of a consolidation phase for the last month or so. It's had this habit of gapping up on Sunday and Monday and then chopping or selling off for the rest of the week. And this week was no different. We had a gap up on Sunday night and we hit the high in the futures basically right on the open. And then it's just been kind of in liquidation break mode ever since. And then I think on Monday we had the lower high, and I guess Tuesday we took out Monday's high but didn't quite take the Sunday high, and it was a poor high, and we had a liquidation break into the close. And then yesterday we had a double bottom in the overnight session in the ES, oddly right at the level I've been talking about being the key. That's the 315 Fed day low, which was 2387.75, and you had double bottoms at the halves, 87 halves in the overnight, and then there was a rally, but it had a low. Another poor high. Then overnight inventory last night was mostly net short, but pretty narrow range, and then we had a liquidation break off the open, only to rally back into the close. And we basically closed at sort of the key levels that I need to see. The key level that I've been watching, 2387.75 and then 2390.75. That's really the important range for this tape to hold. And we basically closed right on it today. So it was, if you're a stickler, and a lot of you know that I am, you could technically say today was a look below and fail. I would have liked to have seen a bit of a stronger close, but we did look below one in SPY now. I'm flipping from ES to SPY. We went through 4 days of range into the fifth and then closed back inside. So technically it's a look below and fail. I think what had happened was we basically kind of got to a double top, and the key now, in my view, in terms of SPY, is going to be to play for a range break. Either SPY will break 237.70, which I think could be a bit of a right or right out short, but the question is where are you going? The 50 MA is right below, and so is trend at 236.59. And then if we broke over the high, which is 240.19, I think that the market will just keep going. I mean, I would assume we would see channel high at that point, and then you're looking at like 242s, 243s, depending on how long it takes. So I guess that's my trade. I would probably try a row short there below the 237.70 with a tight stop. I'd probably trim some at the 50 MA. I mean, you have the 50 and 20 MAs right below. So I don't think this market's in a hurry to go anywhere really too fast. IWM. Oh, if you're ES trader, you really need to see this thing continue to hold the 2387.75. Today we held my tail line of support on the trend. So the market has basically done everything right so far. If you start losing today's lows, that's an initial entry, and then I would enter more on the break if that's what's happened, but that's not really what I'm looking for. Today, IWM was a perfect basic hold to 50 MA. You have the 50 and 100 MA confluences right below, and you close still above the 20. So IWM to me just looks like chop, range chop. Anything over that 138.17, and we still close there, is still kind of okay. I would like a row trade in IWM either long above today's high of day, which would take us back over the 10 MA, or short below the low of day, because I don't know if we'd have a second 50 MA test. And if we did and it held, then you know, like if we had tweezers, for example, then you know we're probably going higher. So that's my take on the IWM. The Qs, you know, holding up rock solid. Brock Landers and Brock Landers and Chest Rockwell have not been disappointing. That's of course my my homage to Boogie Nights. So the Qs are looking okay. I mean, if that were to have some kind of a pullback, I still think people would be in the buy the dip mode. You have a little bit of poor highs in here, so there could be some kind of a liquidation break, but still a buy on 50 MA until it's not. The aforementioned Brock and Chest, Apple and Amazon, as I've kind of named them, they are the kind of the workhorses and the powerhouses of the market. And I guess you could add in NVIDIA to that mix now. I guess that's like the amber waves of the stock market. So a funny thing happened in the morning today and after the close yesterday, and I think that was really why today was a push and pull. It was a push and pull between people who were short oil and got stuffed, basically. And I'll talk about NVIDIA, don't worry. Oddly, that wasn't on my list of in my bag of tricks, but it wasn't in your bag of tricks, but was in mine. So we're going to talk about that in a little bit. So this is what happened. Why was today weak early? I think it was a combination of two things. And no matter what the media, the financial media, who are absolute Trump haters, want to pin, like I was stuck. Honestly, I rushed back to do this video with you guys. I'm playing a little hurt. I had to go to the doctor intraday. But I told them they had to bang me out quick so that I can get back and do my broadcast and be with you guys. But I mean, I was sitting in traffic on the Queensboro Bridge, and I mean, hell, I was going to blame Trump for that too. I mean, why not? Pile on. The Comey firing had zero to do with what happened in the market today. If it were going to, it would have dumped it yesterday, which it did not. Today's weakness was led by a combination of two factors. The IPO failure du jour of Snapchat. There was a lot of disappointment in that, and a lot of the market is based on sentiment. And then most of us don't traffic in these names, but a lot of big institutions do, and that has been the absolute destruction of retail. You came in today with Macy's and Nordy's, which is getting follow-through smackage in the after hours. I mean, they are getting creamed. So there was a lot of confusion today because oil, of course, is being used by the algorithms as a global growth proxy. Yeah, Kohl's, you name it. Even Gap, who had reported a pretty decent quarter, got smacked around too. So it was a push and pull today of the slowing growth crowd because of retail getting creamed, and the pro-growth crowd, I guess, of oil bouncing. They had a pretty bullish inventory number the other day. Let me lower this shade. I'm starting to get glare. I'm right on the river here, and at the end of the day, the sun sets basically right here, and of course, it's right in my eyes. Oh boy. We'll edit that out in post-production, which of course we don't have. So that was why the market was weak earlier. I think it was the early weakness in Snapchat, and then the retail destruction. I mean, if you look at some old line industries, even like Hertz, the rental car business is getting slapped around. I mean, that thing looks like it could be a zero for crying out loud. I'm sure you'll get some bottom fishers here when it gets to 10 or breaks 10. That's going to be an interesting one to watch because Carl Icahn has got like 35% of that company. I can't really see him letting that thing become a zero, but Carl is actually, believe it or not, unlike most of the other billionaire managers of money or self-wealthy or whatever, he's an options expert. A lot of people don't know that, but he used to run an option shop, and the guy is like, I can't even imagine how great he must be. So I'm sure he's got a lot of hedges on in that position. But like before I did my broadcast on my way back, I did a conference call with Jack Horner and the Colonel, and they were telling me about how the future of the industry isn't really going to be on film anymore. It's going to be on videotape. And we then got into discussing the retail blow up, and we of course started discussing how the future isn't in retail stores, but it's going to be online. And then we started talking about Amazon. I think that the pain that has been caused by Amazon and other online retail experts, it cannot be discounted here. People are shopping differently. First of all, I've always hated the department stores. To get me in there, you have to have like major sales, and that isn't the kind of customer really they want to attract. And honestly, I'd rather just wait for my my everyday 50% off at Banana Republic or whatever and do that. I order pretty much everything on Amazon these days. I mean, I order, I return. It's so easy. I don't want to go in. I don't want to talk to anybody. You have incompetent help anyway, and that's when you could find them, when you're not like chasing them down to beg them to help you. You could have online reviews. The world has just changed. It's just a different situation now. And I was having a bit of a debate with a trader who I actually respect, the few that I do who are on Twitter. And I was talking about Walmart. Walmart's had a very big rally off the lows. They used to be kind of the king of retail, and I think Amazon is sort of the new Walmart. And he was saying, oh, you know, Walmart's going to catch up and they're going to be big in online. But my point is that Amazon doesn't have stores to cannibalize. And in my view, the Walmart, if they do go big online, they're probably not going to take a lot of business away from Amazon. They're probably going to just cannibalize themselves. It's sort of like eating their tail to feed the head, right? Like as their online numbers go up, maybe their in-store numbers plummet. And my proposition to you is that Prime is the new Sam's Club. So as crazy as it sounds, I had an accounting class in college, and I remember it had to do with Sam's Club. And I remember I said to my professor, I was like, if my numbers are right here, like a quarter of the country are members of Sam's Club. And she's like, geez, no one's ever pointed that out to me before, but the number was correct. It's crazy. I mean, there was a huge amount of Sam's Club members in the US population. And I haven't looked at those numbers lately, but I know that Prime is on the rise. And I believe that that is really what the retail woes are. I don't think it's necessarily the retail investor the retail customer shrinking too much. I think they've just changed how they shop. I mean, there's an app for pretty much everything. And I know from my own personal consumption, you know, a few years ago I started ordering on Amazon, and now I pretty much buy everything on Amazon. It's actually pretty scary, but that is how it is. And unless I need something like immediately, like if I'm on vacation and I forget my toothbrush or something, you could order it on Amazon. I mean, it is what it is. I think the few exceptions to that are Costco, because they have their own membership, and that's like buying in bulk and a bit of a different breed. So that's my take. Yeah, someone just mentioned FedEx. Yeah, UPS and FedEx, these are like the arms dealers to Amazon.com, particularly UPS. I actually just caught the UPS man on the way out because I had to return something now for the third time, because the quality controls in this are just a joke these days. But that's another story. So I think that's also been a reason for the strength in the transports, because there's a bit of a shift on how people are buying. And I think it's with the advent of the smartphone, it's now like the next iteration. So you're now on a third iteration of this. The first iteration was the net. The second iteration is now smartphones. And the third iteration, and I better mute her before she starts flipping out on me, is the Echo, the Amazon Dot, Alexa. So you can now order on that too. So God knows what else they're going to do next. I mean, soon you'll just think it and it'll be at your door. So that's the scoop with regard to online. I think they've just made it easier and easier. And honestly, the retail experience, and I guess I'm now an Amazon big league fanboy. I mean, I'm playing long the stock, so that's good. But even Warren Buffett was praising Jeff Bezos. I mean, I don't necessarily love Jeff's politics or even him himself, but I think he's one of the best managers and probably the best retailer potentially of all time. So that's the scoop with regard to Amazon, and they are being referred to as Chest Rockwell. Brock is Amazon, of course, and that's my homage to Boogie Nights. Someone's talking about a few brand names. I think the real reason why, one of the reasons why the retail stores are getting nailed is because there's no margin anymore. It's sort of like when stocks went from fractions to decimals. The brokers got nailed because they couldn't charge the difference between the spread anymore. And online and mobile and all of that has compressed the spreads. So there's no need for the middleman anymore. Like if you're a big store brand, what the trend has been is you open up your own stores. Like Nike has their big stores. Oakley now has these big mega stores. North Face has like a mega. When I was a kid, I used to be dreaming about being locked into FAO Schwarz at night and playing with all the toys. But I mean, honestly, if I was locked in overnight at North Face, I mean, you might find me like half slung over the counter with like mountain gear on. So I mean, this stuff is Under Armour now. I mean, these are huge stores. So they're either selling direct through their own stores, online, or they're bypassing their middlemen. So I just don't see the middleman kind of, now that there's this direct to customer. And if anything, social media has made that even more possible. You see how this stuff is all linking in? Like celebrities or singers from now on can have millions of followers on Twitter or on Facebook, and they could bypass studios now to do direct sales of music. I know there's like a lot of upstarts. Trying to think of a good example. Like Lindsay Sterling, for example. She was on America's Got Talent. She's that cool violinist who does like the hip-hop dancing and stuff. She sells her stuff directly, basically, to customers. She's got, I don't know how many millions of YouTube followers. And she doesn't need a label to produce her necessarily. I'm not sure if, I know she's done music for like soundtracks in video games like Assassin's Creed and stuff. But there's this direct B2C now that there never was before. I mean, for crying out loud, social media got our president elected for direct to voter communication. So that's what I think. This is killing the retailers. They're still in an old business model. Think of OPM, Other People's Money, that movie with Danny DeVito, the buggy whip manufacturers. That's a great example. So I am definitely bullish on Amazon on any large pullbacks. It seems like, I know everyone loves it now. It gets me a little nervous when something is so universally loved and there's a little bit of topping action in chest. We had that kind of doji topping tail above the high on a gap. Now we're just consolidating. I think this thing is just going to be a chopper, a sideways chopper for a little while, and maybe there's a pullback, but I honestly think this thing gets bought. Any move to the 50 MA, I know it's a lot point-wise, but I think this thing is a buy via short out of the money puts if you don't want to, stock up on a $900 stock. I wish they'd start splitting these damn things, by the way. So we cleared Amazon for shizzle here. Yeah. What else do we want to talk about? Apple. Something is going on with Apple. I don't know what it is, but this stock is moving. Often when I want to be long or short something, I remember this was, last Friday. I saw it clear the old all-time high, and I hadn't had a position on it, and I put it on right as that cleared, and I said to myself, this is no stock I want to be short of by any means, and it just blew up. I mean, it closed at the high on Friday, and then Monday was like open flat, but just ripped, and then this thing is just going. I think it's just going to consolidate, chop sideways. I think that this thing will probably peak short term around the Worldwide Developer Conference in June, in a couple of weeks, at least for a bit of a pullback. So Apple, I still think could go a little bit higher and is still a buy the dip stock via short out of the money puts at strikes, low strikes below the range if you can get them. 50 MA is about 143.20. So any pullbacks to like that 50 and 20 MA, I think probably still get bought. Nvidia, this thing is a beast monster. So here's the scoop with the Nvidia. It had a pretty bearish pattern. I'm not going to lie, I was a little worried about this. I didn't really have that much of a bias on this stock. I will say this, if it wasn't earnings, my instinct would have thought it was a long, but I've seen patterns like this fall out of bed before, and I knew that there would be follow-on trade potential either on a dump lower or a move higher. And in the after hours, once I saw the move was up, I had a bunch of people message me, what do you think of Nvidia? And I said, it's not down, so it's going to go to new all-time highs. So it is. It's up on huge volume. I think that this thing will just now chop. It was up big yesterday, big today. It didn't close at the high, but it closed decently. As long as you're above that 119.93, 120.92, that like area, it probably is going to just chop sideways. I see supports in like 110s to 108s now. And I mean, even if this thing for somehow or some way got the gap fill, I think it would get bought. It broke the range. If you want to multiply the range times 2, I mean, I guess you could do that. You could do the 1.618 fib extension, which is 136.64, which I think is at this point probably a foregone conclusion. But it might take a little while to get there. I wouldn't necessarily chase it outright, but I do think NVIDIA is probably going to work its way higher. Holy shnikes, I got a lot of stuff to cover. Tesla, wow, those shorts are just the, you know, how many times can you get your head handed to you until you like just decide to leave? These people are like gluttons for punishment. They must be like the people who enjoy, all right, I almost slipped into something that was non-kosher there with a conversation, but they must be people who enjoy pain. I was going to get a little bit more graphic, but I decided not to. I said that I didn't think that there would be a lot on the conference call for people to get bearish on. It wound up getting a pullback. It retested the breakout perfectly and now is back up to highs. I think this is a thing that probably just grinds sideways to higher. Any pullback, in my view, to trend or the 50 is likely a buy. In next month, June, I think it's in June, we have the Model 3 launch, and then September, you've got he's going to launch trucks. I mean, this guy is just unbelievable. So Tesla to me looks okay. I don't know, like again, it's one of my buy the dip June, so July even Model 3. So I think this thing is just going to stay strong for a while. Any pullbacks, I still like it. The Netflix, let's see, that had a little weakness today. This still has a pretty bullish pattern. Historically not that strong in the summer. We're getting close to my PTs in the 164s to 168s with the 166s right in the middle there. I want to lighten it up into that area, in my humble opinion. All right, so we covered that. There's a few on here I'm not going to cover. Let me decide which ones. I guess we could. Some of these are quick. PayPal, quickly. We are getting fast approaching my $50 price target, 50.51, which is the channel high. It's probably a good idea to sell some into strength, but this one, you know, I said a couple of months ago, I had a lot of people ask me what's my favorite stock for a potential takeover target. This was it. I think that this is not a standalone company sometime in the next few years. It's just a great business. They are killing it with Venmo, and I know that they're starting to get some competition, but honestly, so many people I know are on Venmo. It's just incredible. It's just a great peer-to-peer payment platform, and it's doing well. I mean, a lot of websites even now, I go to like check out, most of them all have PayPal. Some of them have Apple Pay. I just can't see how, if Tim Cook wants to do a really big league deal, this to me would be a no-brainer for them, for Google, for Microsoft, anyone. I mean, you name it, even the Verizon or any of these companies, I think, could benefit from this. That being said, the thing is way overbought at this point, and I want to sell into some strength and then rebuy it on some kind of a decline, which does get once in a while. Priceline got the channel high. Remember we talked about that in the weekend video. It's back to the breakout here. I think between here and the 50 MA is sort of the kind of important hold. The gap fill down in the channel low is 1632. I don't know if we get that, but I could see this thing getting back to like 1748s maybe. In that area, I do think that this will probably get a bounce to a lower high before it would get the channel low, so I'm not that concerned about it just yet, but it got the channel high. I said it was either, it was going to be a short for earnings, either on some kind of strength or outright, and it wound up getting the channel high before, so yeah. Expedia, the same kind of thing. It just missed the channel high. This thing is holding up a little bit better. It's getting a little sunny again here. So Expedia is one. I actually like Expedia. I would just like it lower. 50 MA, I'd be a buyer. I'd probably sell out of the money puts at the whatever the 200 MA price is at the time. So that's my scoop with that. This Shopify is just completely going ballistic. Very steep. I would definitely not chase this as a long here, but it's been holding a trend line. Just connect the dots and buy the trend if it gets a pullback. If it has a 50 MA confluence at the time, very good. Not one I follow that regularly, but looking pretty strong. EWZ, not one I cover very often, although I do have a pretty good trading record in that. Breakout looks good, probably goes higher. It's clearing some consolidation. It's testing into the gap. Any rollback into this thing anywhere near the 50 MA, I think, is likely a buy the dip situation. You could either do it with call spreads or risk reversals or risk reversal call spreads or some type of vertical play to the upside, I think, on any weakness. XLE has a excess low on a what's now starting to look like a look below and fail on range below 67. It still is in a downtrend line. This needs to clear the 50 MA in my view to really begin some repair. It's right at the channel high here and the 20 MA. I guess you could use the 2-day range as a guide. Long above or short below is my call there. And if it were to break, I think it would see the 200 MA. But these stocks have not been the best. Exxon, and while we're talking about these stocks, Exxon is just in chop mode down here. I actually had been short a bunch of puts, and by the grace of God and sideways price action, I didn't get killed in them. They actually got pretty badly beaten up, which was great. And into some strength a couple of sessions ago, I rolled them down and out. So I had been short 80s. Now I think I'm short 77 halves. They're actually a little bit longer, a little long dated for me, but I'm confident in that range, and I would be looking to add on weakness. The aforementioned oil. Let's talk about that. That's kind of important. Intraday, the algorithms are tied to this thing, and you'll often see if it's weak, it gets Nastola. And I talked about if we couldn't hold 49s, we would see the 2 times range low, which was 43.98. We got a little through it in the overnight session, and now we're back up. Back over, that was through the 61.8 fib, and now we're back up into the 38.2 of the range. I think this has some room to 49, maybe 50. But since we didn't hold 47s, I'm a little leery up there. And we're going to have to see how it takes the price there. If it can get through 49s and hold, this will have all just been a bad dream for the move lower. I think oil, honestly, and I've said this for a while, I think it's just going to be pinned in a range for a while. I think you have a lot of people, risk managers in companies that are hedging out portfolios, like HYG situations, so that they're not having problems. And again, by the way, that bad boy held the 200 MA, double bottom, now held the 50. You're not going to see a real credit crisis, in my view, until you start seeing a break of, well, the 200 MA now is so high. I'm going to have to revisit this, which I will leave for the weekend review video. But oil, I think, is just going to be range bound for a while, and it's going to be really choppy in range. Silver and gold got slaughtered, and I think that just had to do with a few things. One, they ran a hell of a lot into some reference resistance areas. And two, the contract open interest got just ridiculous with the speculative longs. I mean, gold looks to me neither here nor there. It may want to rally from here. It may want to pull back. I mean, 110 to me would be an interesting level. It's trend in the 78.6 of the range. Gold also like 61.8, so I mean, there could be some downside, but I don't think this is going to absolutely just completely collapse. And I would need to see a trend line break now at this point for me to get bullish, which I will show in the weekend review. Silver is right around the 78.6, which I bought the other day. I took a smidgen of pressure, but now I'm not. I'm up on that, but I think that this is going to be choppy for a while. This pulled back too much. I think it'll probably retest the breakout point in like 16s, maybe mid 16s, but I think this one is just going to be range bound and choppy for a while. I don't know how much risk there is on the downside. Famous words for commodity stocks, because they tend to go way further and for longer than people can stay solvent, but I think this sucker may have some bounce in it to it. And I have been getting involved now in the lower part of this move lower. What else did I want to discuss? There were a few other topics. The bonds. Keep an eye on that, this TLT. You've held right where you needed to hold here, these like 120 area, 119.73 to 120. It closed okay today. Yesterday, the last 2 days, you look below the 100 MA. Now was the third look below. Now, I want to school you boys and girls on bonds here for a minute. The media, in all of their infinite wisdom, doesn't seem to understand the relationship between price and yield. Stocks are valued on what's known as a discounted cash flow model, DCF. Google it. It is probably going to be in the notes, a little spreadsheet from my alma mater that you can play around with and just see the effective rates on DCF. A lot of people don't know, a lot of followers here don't know that I was really trained in college. I majored in both finance and marketing, but I'm basically trained as an analyst. That was sort of my, what I do now, I mean, with regard to trading is very different. They didn't really train you to be a swing or day or whatever the hell you want to call it trader in college. It was basically DCF analysis and valuation. It was all about valuation, and the key in that function is interest rates. And at the time, we would use a given level of 5%. That was the understood normalized discount rate for discounted cash flow analysis. The Fed now has told us that the new norm is 3.5%, 3 to 3.5%. So you basically have lowered your hurdle rate by your starting point from your hurdle rate. It's usually I don't want to get it too into DCF analysis, but you start out with your risk-free rate plus your risk factor, and now your starting rate is lower. So this makes project PE multiple valuation a premium because of the low interest rates. As interest rates rise, as bonds sell off, that premium has to come in a bit. If bond prices rise and yields drop, PE multiples deserve a premium. That's why all of these years with ZERP, the FANG names have done well. These stocks require low interest rates for return, for these excess returns, so these excess PE multiples. What happened in 99 and 2000, 2001? Greenspan, then Infinite head share. Sorry, I got to put a hat on. It's getting way too bright over here. In all of his infinite wisdom, he thought raising interest rates 17 times was the correct move. And that basically brought bond yields up to 6%. Bingo, smackdown. That is what happened in 1929. That's right where interest rates peaked back then. The Fed, in their all infinite wisdom, their all-knowing wisdom, have decided that they are going to not normalize to 6%. I heard a very prominent bond manager said he thinks in a couple of years the interest rates will go to 6%. I don't necessarily agree. I mean, I don't run billions of dollars, and I'm not the new bond king. But we'll see. I mean, if that does happen, the market is not going to be so thrilled unless we do experience a period of very serious growth expansion. In that case, I think it will be okay. But if the interest rates are low, and the bonds don't necessarily even have to rally, they just don't need to tank the market could stay at a PE multiple premium. If bond prices start dumping and yields start going up, that will not go over well for the stock market at some point. So what is the argument, the press argument? And it's always the same argument, and it's the same argument. I'm sure a few of you are going to be smarty pantses and type me, and that's, oh, Justin, the bond prices going up and yields going down are a symptom of a recession coming. No, that is not what's happening. I've looked at the economic data. There's no recession imminent right now. Growth is slow. It may go through stutter steps, but fiscal policy is, we're talking about no more new regulations, talking about tax cuts, we're talking about repatriation, we're talking about repeal and replace of Obamacare, which, by the way, is a huge tax on businesses and consumers. This is all growth positive, getting rid of regulations. This is all growth positive stuff. And it will happen. It may take longer than expected, but I'm pretty confident that it will take place. I think a lot of that optimism got front loaded and it pushed into some of the stocks a little early, and they got ahead of themselves, like some of the materials, like the steels, like the banks, for example. The banks, by the way, are not rallying on the prospect of higher interest rates. They're rallying on the prospect of deregulation, and any hiccup to that is not good. So that's the story. That's why the banks have been rallying, because they've been utilities for so long, and just the prospect of them being able to make money again is why they rallied. And you need to now start seeing FinReg deregulation, getting rid of Dodd-Frank. I don't want to go through the litany of stuff that would need to be, maybe the Durbin rule, all kinds of stuff needs to go. I think the response to the Great Recession was to over-regulate an industry that really wasn't as responsible for the crisis as they were vilified to be. Yes, there were some very bad actors, but what really caused the crisis was weak lending standards. No, it's Dick Durbin, not Frank Durbin. Or maybe it's Frank Drebin. Little movie Easter egg for you guys there. It's the Durbin interchange fee, for anyone who wanted to look it up. That's not the big deal. Yeah, Naked Gun. Yeah, you got it. I like that. Props to Cody over there. Anyway, not to get too off the... Listen, I would love to do a channel with just where I talk to you guys about movies, but I don't think that many of you would really watch. Anyway, the scoop there is that they need to do some FinReg, and I think that what caused the crisis was loose mortgage lending and the repackaging of those loans into securities, which then got sold. So they basically made all these crappy loans, they rolled them up into a big ball, and then they sold that ball to other people. So if you can sell crappy loans, not have to take that default risk yourself, and you sell it off to other people, and then they take on that risk, you make a lot of money. So this is what happened. And believe it or not, this could all happen again. Nothing in the financial regulations have done anything to address that. I don't think that the next credit crisis or the next real recession is going to be caused by that. I have my suspicions about what will cause it. I think it's going to start with mass layoffs with artificial intelligence and automation, but for another discussion. I think we're in an upcycle in a larger cyclical downturn. We are in structural downturn. We have a cyclical upswing in employment. So that might pick up soon. I think I want to leave the video there because we're starting to get into overtime, a lot of time being spent on this video. And I know I don't want to keep you guys much longer. I don't speak Spanish, sorry. So that I speak technician, that's what I speak. Anyway, thanks for watching. If you missed the video or you want to watch it again, or you just like to hang out with me, it will be on my YouTube channel, which is Justin Pulitzer Trades. I highly, highly suggest, there's a little, first of all, there's a little button that said subscribe. Hit that. There's also another little icon next to it, which it looks like a little bell with a plus. Push that button, and you'll get notified the minute I go live or I post the weekend review videos. I don't post me petting puppies, although that would probably bring my subscription rate over 1 million, but hey, we're doing it for the people here. Anyway, hit me up on Twitter at Justin Pulitzer. Have a great rest of your week, and I will see you either by Sunday. We'll leave it at that. That's my weekend review video. Have a great rest of your trading week, and cheers.